You've been told your entire life that the stock market is a place where you put money in and it grows. You've seen the charts, the line that goes up and to the right, the promise of the American dream packaged into an ETF. But here's the uncomfortable truth they don't tell you in the glossy commercials. The stock market isn't designed to make you rich. It's designed to take money from the inpatient and give it to the patient. And right now, there are people in suits sitting in offices.
They aren't smarter than you. They don't have a crystal ball. They just understand something you don't.
They understand the mechanics of the machine.
And once you see how the machine actually works, you'll realize you've been playing a rigged game with a rule book you never actually read.
Let's fix that. Close your eyes. Picture the stock market.
If you're like most people, you're picturing Wolf of Wall Street, yelling, red phones, a chaotic pit of greed.
That's the performance. That's the circus. The reality is much quieter, much more boring, and much more dangerous. The stock market, at its core, isn't a place to make money. It's a place to transfer money.
Let's go back to the beginning. 1602, the Dutch East India Company. They had a problem.
So they did something radical. They chopped the company into 1,000 tiny pieces, shares, and sold them to regular people.
So again, the deal was simple. Give us money to fund the voyage. If we come back with spices, we share the profit.
That's it. That's the original deal. A stock is not a lottery ticket. A stock is a receipt of ownership in a business. When you buy a stock, you are buying a tiny slice of that company's future profits. So, if it's that simple, why does it feel so confusing? Why does the screen look like a video game?
Because somewhere along the way, we stopped trading companies. We started trading stories about companies.
Imagine you buy a house for $100,000. You live in it. It's an asset.
Now imagine you sell that house to your neighbor for $150,000 6 months later. Did the house do any work? Did it get bigger?
The only thing that changed was what someone was willing to pay for it. This is the stock market.
When you hear on the news that the market is up, they aren't saying that all the companies in America suddenly doubled their profits overnight. They're saying
This is called the secondary market. The company, the Dutch East India Company, or Apple or Tesla, already got your money back when they first sold the stock crew.
Every trade after that?
That's just you and a stranger arguing over the price of a receipt.
Here is the irony. When you buy a stock from a brokerage app, you aren't investing in a company in the way you think you are. You aren't handing cash to the CEO to build a factory.
You are handing cash to some random person on the other side of the trade who decided they wanted to sell.
And this leads us to the first uncomfortable math problem. For you to buy a stock at $10 and sell it at $20, someone has to be willing to buy it at $20. If no one is willing to pay $20, your stock isn't worth $20. It's worth zero. We call this liquidity. But what it really is a chain of greater fools. To understand the machine, you have to understand who is playing the game.
Most beginners think the market is just people like me trying to save for retirement. But you are a minnow. You are in a tank with sharks.
Let's name the sharks.
First, the market makers. These aren't traders. They are algorithms. Their job is to keep the game running.
Second, the institutions. Pension funds, sovereign wealth funds, BlackRock, Vanguard. They don't trade stocks like you do. They trade based on math. They detect patterns. If a stock drops 1% in 1 minute, their code says, sell another.
And then there is you.
The retail investor. Sitting on the couch, reading Twitter, trying to figure out which stock to buy based on a meme you saw 5 minutes ago.
Here's the irony that should make you skeptical.
When you buy a stock because you think it's going to go up, the person selling it to you, the institution, the algorithm, is selling.
You aren't playing against the market. You are playing against someone who has a team of PhDs, fiber optic cables running directly to the exchange servers.
You aren't gambling. You are walking into a casino where the other players can see your cards. So, if it's just a guessing game, how do you win? You stop looking at the price and you start looking at the business.
There is a concept called fundamental analysis. It sounds academic, but it's just common sense.
If you wanted to buy a pizza shop down the street, you wouldn't ask, how much did the pizza shop next door sell for yesterday? You would ask, how much profit? If it makes $100,000 a year and the owner wants $1 million for it, that's a valuation of times earnings. Now, look at the tech stocks we all know. In 2021, some companies were trading at valuations of 100 times earnings, meaning if you bought them, it would take a century. Why did people buy them? Because they thought someone else would pay more tomorrow, not because the business was worth it. This is the greater fool theory. It works until it doesn't. And when it doesn't, that's when the machine eats you. Here is where most beginners get destroyed. It's not the math, it's the psychology.
The market doesn't move in a straight line. It moves in waves.
Let's say you buy a stock at $100. It's a good company. You did your research.
The next day, a headline drops. Recession fears.
The stock drops to $90.
If this were a house, you'd shrug. Oh, the market is slow. You'd close the Zillow tab and go eat dinner.
But because the stock market updates every second, you feel like you've lost money. You feel like you were wrong. You panic.
At $80, you sell. You lock in the loss.
2 weeks later, the recession fears pass. The stock goes back to $100. Then $110. You lost money. But the person who bought it from you at $80 made $30.
You didn't lose money because the company failed. You lost money because you lacked the patience to let the company do its work.
Your emotions are the product being sold.
The news channels, the Reddit threads, the green and red lights on your phone, they are designed to trigger a reaction. Because every time...
So, if the system is stacked against the day trader, if the algorithms are faster, and the emotions are deadly, how does the average person win?
They stop playing the game. There is a term you've heard, dollar cost averaging.
It's boring. It's not sexy. It doesn't get likes on TikTok.
It works like this. You decide to buy $500 of a broad market index fund, basically buying a tiny slice. When the market crashes, your $500 buys more shares because prices are low. When the market booms, your $500 buys fewer shares.
You stop trying to predict the future. Over 20 years, you stop caring about the price. You only care about the accumulation of shares. This is the boring middle. And it's where 99% of the wealth in the stock market is actually built.
But nobody wants to hear that. Because it takes 20 years. And we want it now.
So, let's go back to that original lie. The stock market isn't a get-rich-quick scheme. It's a patience tax.
It's a mirror. It reflects your worst impulses, greed, fear, impatience, and prices them accurately.
The institutions aren't betting against your money. They're betting against your discipline. You now know the definitions. You know what a share is. You know who the players are. You know why the prices move.
But knowing the rules and playing the game are two different things.
The question isn't whether you can afford to buy a stock.
The question is, when the news is screaming disaster, when your portfolio is red, and every instinct in your body is screaming sell,
will you have the patience to just sit there and do nothing?
Or will you hand your money to the person who does?
My fade to black.